We want to bring you some market commentary that's sticking out to us this morning. First up, Treasury yields are down this morning, pulling back just a bit as you see some investors turning to the bond market for safety. Your investors are looking to de-risk, flocking to some of the havens on signs that Israel is gearing up for a ground invasion of Gaza. Now, the prospect of higher for longer interest rates boosted by yesterday's hotter than expected inflation data is also weighing on risk appetite. Now, in a note out yesterday, Bank of America strategist Michael Hartnett is saying that the U.S. stocks could avoid a big drop. They just need yields to stay under 5%. In such a scenario, the S&P 500 can continue to trade above 4,200 in the near term, but factors could drive the index below that level. Now, Hartnett flagging a stronger dollar, oil rising above $100 a barrel, and unemployment fueled by smaller businesses feeling the credit crunch pain. Obviously, all scenarios that investors are keeping a very, very close eye on. You mentioned that 5% level in yields, and that certainly has been a critical level here. We've heard that mentioned a number of times here at Yahoo Finance from business leaders, from strategists, from economists, just in terms of some of the levels that we need to keep in mind as to how much pressure that higher yields could put on the economy even further than they are. Now, of course, that begs the question whether or not the Fed needs to hike again. But interesting commentary there. But like we said in that intro there, a lot of scenarios, a lot of unknowns that could certainly dictate the direction of this market in the short term.
Yeah, really interesting commentary from Michael Hartnett here. And I love the title of this note as well here. One of my pastors growing up would say, it's not good English, but it is good preaching. Superman don't need no seatbelt was the title of it. And particularly here, one of the things, if for those who are fans of the Magnificent Seven, we're looking for something to extrapolate from this note. You got that out of the second point, the zeitgeist here. Take out your Magnificent Seven, though, from the S&P 500 this year, and the index would be 3890 right now. You've got to look at it in the bottom corner of your screen right now. Yeah, we're well off of 3890. We're at 4364. So at this point in time, it just goes to show how significant the Magnificent Seven have been, especially in this AI wave, which is now transitioned into a show me story. So keep close tabs on that. Also, with the Magnificent Seven, just furthermore, at a new high of about 30% of S&P 500 market cap. That's important. They're trading at 30 times PE versus the rest of the S&P 500, which is at about 16x. So all of this considered, this could cause perhaps a reset or at least a reevaluation of how people are looking across some of the other names in the S&P and as well for the Magnificent Seven. If they don't show this quarter specifically that there is a pathway towards this larger AI wave that was in hype earlier this year, is now in show me, as we were mentioning, and now is going to need to trickle through to some of the financial performance and bottom line and margins here, I think that's exactly where you're going to need to see something said over the course of this earnings period that we've just commenced, where those big tech companies can deliver upon some of those AI dreams, goals and ambitions.
Yeah, certainly. And it's also interesting when you take a look at some of these flow numbers here, because we know that's something that the street very closely watches. Treasury is the largest weekly inflow that we've seen since March of 2023. So certainly a reversal from what we've seen in prior weeks. Obviously, a bit of a de-risking here, given the heightened geopolitical risk, given the fact that the inflation fight seems to be far from over. So certainly as something to note there, as well as investment grade bond inflows of just under $1 billion versus high yield bond outflows of $2.6 billion.